Hello YouTube family, welcome back to another video. I come today for some more nuggets as always, and today you are in for a treat. So there's this thing I want to show you guys. I have talked about this before. It's called SMT divergence. This is a great concept for you to understand. It's a smart money concept by ICT. So SMT divergency basically is just a divergence instead of the RSI divergence, which is most people use, which is what I use as well. SMT divergence, we are looking at a divergence between two correlated pairs. So in my case here, I'm looking at S&P 500, and I'm also looking at Nasdaq, right? So this is something that has happened today, happened twice today. So this is something that I have been forward testing. I have not started putting this into practice yet, just because you need to gather data before you actually start applying anything. So when I woke up this morning around 7 a.m. UK time, as always, I saw this price action here happening, right? As you can see here, 8 in the morning. So you guys can see how, so we had a nice pool of liquidity here, right? We had a double top. Basically, you can see how price swept this double top and then made a break of structure in here. Now when we look at S&P 500, which is correlated to Nasdaq, they are supposed to be doing the same thing. They are always doing the same thing. They did something a little bit different, right? So you can see here how S&P 500 failed to break the highs above. Instead, it just made a breaking structure. So this is a divergence. So what this is signaling to me, or anyone that actually understand this, is that price wants to keep going lower, but Nasdaq made sure to grab this liquidity before making the big movement, because we've already talked about this before. The markets are manipulated. Before the big guys make the big move, they need to grab liquidity, right? They need to fill in their sell orders. In this case, they want to sell, so they need to sell. They need to fill their sell orders, which with these buy orders, which are stop losses. There's a pool of liquidity here. Whenever you see tops, or if you see a double top, this is a pool of liquidity, right? There's a lot of stop losses here. In fact, you can see how we filled the smart money sell orders. I was going to say my orders, but I wasn't really selling these. The smart money selling this, and then we made a big push downwards. Now we seen the same thing happening again down here. Now again, I'm not gonna say I took this trades because I still don't trade this. Sorry about that, guys. Had to stop the recording a little bit because a friend of mine came to give it back. So like I was saying, we've had the same thing happening here. So we had a liquidity point, which was a very old liquidity point. It was a few days back. I cannot recall on the 1 minute, but I had this liquidity point marked down. So you can see here how basically same thing as always. We sweep the liquidity point, we make a breaking structure, and then we can mitigate that before going up. And this is Nasdaq, but when we look at S&P 500, S&P 500 never broke the low. This is a divergence, right? So S&P 500 never breaks this low. Instead, we just have a break to the structure upside, to the upside. So what this is telling me again, so this is telling us that we want to move upwards, but Nasdaq is grabbing liquidity before moving upwards. And we also have the confirmation that S&P 500, it's holding the low. So we are still strong. We are bullish here, right? Plus, we have a break of structure, which is what we always look for. So yesterday I was talking about having liquidity sweeps as point of interest, right? So we have demand zone and supply zone as points of interest, but now we are also looking at liquidity sweeps. And yesterday I did a little back testing about liquidity sweeps. They were somewhat profitable. They are profitable, but the win rate is, it's a bit lower to me. It's not worth it. Now when we do take into consideration liquidity sweep plus SMT divergence, which is basically signaling that that is an actual manipulation and it's not just something else, So we have manipulation, liquidity sweep, and break of structure. So these are three great confluences to add up to our game. So I'm now going to start testing this out, and having supply and demand zones, look for a liquidation and a break of structure in the main zone, plus having liquidity sweeps and looking for, well, the liquidity sweep is already a sweep, and then after that having a break of structure. Now another thing that this might change is that, like here for example, I cannot say I would have taken this trade, right? So we had a nice 69% retracement, but the only thing is that this retracement happened way too fast, right? So the break of structure happened over here, and literally almost 2 minutes later, we are already retracing, right? So we actually only got tapped in here, which was like 7 minutes later, but still, sorry, this would not have been the one. So the one we get in actually is the one where the liquidity sweep happens, right? So this this retracement actually only took 2 minutes, right? So the moment this happened, in 2 minutes, this was already being mitigated. So this, I cannot say we would have taken this unless I was in front of the charts, like staring at the chart. And then, but another thing that happened as well is that the one that happened this morning, we never got the 69% retracement, right? So we only got a 60% retracement. I was looking at it. It's funny because I see all these things happening, and I'm like, oh, I want to take this position so bad, but at the same time, I cannot, because this is not really my strategy, right? I'm only forward testing this. The moment where I actually start adding up, you see, the 69% retracement came like really, really close. I don't think I would have been tapped in here. I don't think I might have been tapped in. So you see, so this is definitely something I have to look at now. I don't know if there's ways for me to actually, how can I say, test, back test with two different assets, right? Because the way I would have to do this, I would have to start back testing on Nasdaq, and while I'm back testing Nasdaq, I need to see what is happening on S&P 500 to see if I actually see some divergence, because I don't think this happens every day, right? Like, there's no way this happens every day, and I also don't think this is 100% win rate. Like most people talk on Instagram, people like, oh, I have a 90%, 80% win rate. That is cap. That is cap. If I can get a 50% win rate and I can keep a nice risk to ratio 1 to 3, I'm really happy. I'm really happy. Now, if my win rate also goes up to 70%, then I'm gonna start banking a lot of money. I'm happy, and we make this money. But yeah, that's pretty much what I wanted to show you guys for today. Thanks again for watching. Thumbs up, comment, keep coming, and I'm only getting started on my journey. I think I've only started posting videos a month ago, and I've actually only started taking this thing serious like now, because I think the fact that I have to make videos, and I'm always here, I'm putting in more work, right? I'm doing a lot of back testing. I'm trying out things. I'm seeing what's working less. Like for example, I started testing out this liquidity sweeps point, but they are not that great, right? You can still be profitable with them, but it's just the win rate is not great, and I don't like when the win rate is not great, because your psychology gets really affected. So unless I have a really, really good risk ratio, which can be a bit difficult, then we can overlook the win rate. But if it's not the case, then it's not even worth the headache. So thanks again. I'm just yapping. I'm sorry about that. Have a good day. Peace, love, always. Bye.